This is part 4 in our short-term business decisions series, and here we're going to be discussing the dropping of products and how to determine an appropriate product mix. So when management determines which, if any, products to drop, departments, or territories to drop, there are certain things that have to be considered. Firstly, does the product provide positive contribution margin? So you have to think back to our contribution margin income statement that we looked at earlier. Remember the contribution margin income statement, it separated our cost by behavior into variable cost and fixed cost. Contribution margin was determined by taking sales less our variable cost. That gave us contribution margin. Will dropping the product affect sales of the company's other products? So if we drop a certain product, is that in some way tied to one of our other products? What can be done with the freed capacity? So if we drop a product or department, is there something else we can do with the capacity that we've freed up? Is there another product that we can make, or is there a special order that we can accept? Are there any unavoidable fixed cost? Unavoidable, that means that we can't get rid of them. They're going to be there whether we drop this product or this department or this territory or not. They're unavoidable. They're going to remain there. They will just shift from one product to our remaining products. And then we need to look at, are there avoidable fixed cost? So if we're deciding whether to drop a product line, are there fixed costs that will actually go away if we get rid of that product line? So the decision rule, should we drop a product, department, or territory? Well, if the lost revenues, so that means revenues that you will no longer have, from dropping a product, department, or territory exceed the cost savings from dropping, then you do not drop. If the total cost savings exceed the lost revenues from dropping a product, department, or territory, then you will drop the product, department, or territory. So now let's look at product mix. When we're looking at what product to emphasize or what mix of products to have, we first have to think of what constraint or constraints stops us from making or displaying all the units we can sell. So think about shelf space. You may have limited shelf space to show these products, and some products may take up more space than other products. So in looking at this, you want to think about your constraints that you have. Which products offer the highest contribution margin per unit of constraint? So again, if one product takes up a square foot and other products take up a square inch, well, the products taking up a square inch may not sell for as much as the product taking up a square foot, but the contribution margin per unit of constraint may be higher because it does take up much less space and you can put more product there. So it's definitely something you have to consider. Would emphasizing one product over another affect our fixed cost? So again, are there any avoidable fixed cost if we emphasize one product over another? So the decision rule of which product to emphasize, you always emphasize the product with the highest contribution margin per unit of the constraint. So whatever your constrained resource is, it could be shelf space, floor space, table space. It just depends on what your constraint is.